Hey everyone, welcome back to Corporate Decoder. Today we're diving into Workiva's latest proxy statement. It's a bit like their annual shareholder meeting, a yearly peek into the company's plans, big decisions, and how everyone on the team is getting paid. And trust me, sometimes those compensation packages can raise eyebrows. Workiva, based out of Ames, Iowa, had a pretty good year. Subscription revenue jumped by 20%, which is great. Operating margins improved, meaning they're making more money per dollar and cash flow hit record highs. Workiva helps other businesses with reporting, especially where accuracy is key, like dealing with complicated financial regulations. So what are the big items on the agenda for the meeting? Well, stockholders are going to vote on electing directors' executive pay and even whether to make it easier to protect company officers from certain lawsuits. We'll break down what each of these means. First, it's good to know that this is a preliminary proxy statement, which means it's not quite final yet and still has some subject to completion mark. Let's look at the important stuff that might affect investors. If you're a stockholder, you're receiving this because the board wants your vote on some important things. One crucial thing is to elect 3 Class 2 directors. The board nominated Asta Malik and renominated Esther Malik and renominated Esther Malik and renominated Esther Malik and Rija and to get these people elected, it only requires a plurality. But there's other things on the table. There's also an advisory vote on executive compensation. Do stockholders approve how the top people get paid? There's an advisory vote on how often stockholders get to vote on executive pay. Every year, 2 years, or 3 years. There's also something about amending their corporate charter to protect officers and approving their accounting firm Ernst & Young. If you owned Workiva stock on March 31, 25, you get to vote. Each share gets 1 or 10 votes depending on whether it's Class A or Class B common stock. Workiva says that certain directors like Michael Crow, Robert Hares, Asta Malik, David Mulcahy, and Suku Radia are independent, meaning they don't have personal ties that could mess with their judgment. Non-employee directors get paid in both cash and stock. For 2024, they received $50,000 just for being on the board. Some roles like chairing committees pay extra. Then they also get shares of stock. Non-employee chairs get an additional $77,500 a year, while members get much less. Let's check out the director compensation table. David Mulcahy made $320,000, while Martin Vanderploeg made $342,500. Alright, who owns Workiva? According to this filing, the Vanguard Group owns 11% of Class A shares, while BlackRock owns 10%. Matthew Rizzi controls over half of the Class B shares at 55%. Julie Iskow, the current CEO, took over in 2023. She previously held leadership roles at Medidata Solutions and WageWorks. She's also on the board of Five9. Before her, there was Suku Radia and Brandon Ziegler. These are important people to follow as they make the decision about where Workiva goes as a company. Brandon Ziegler, for example, is the Executive Vice President, Chief Legal and Administrative Officer, and Corporate Secretary, and he makes the company sustainable. Now for the juicy stuff, executive compensation. The compensation committee makes decisions about pay for the top executives. They want to attract talented folks, reward good performance, and align executive interests with those of stockholders. It sounds pretty reasonable. Let's see who we are talking about. Julie Iskow, President and CEO. Jill Klind, Executive Vice President. Chief Financial Officer Brandon Ziegler, Executive Vice President. Chief Legal and Administrative Officer, and Michael Hawkins, Executive Vice President, Chief Sales Officer. Workiva revenue in 2024 was $38.7 million. Their net cash increased from $70 million year over year. Good trends. The thing is that company is not profitable yet. There was still a net loss, though it's been decreasing recently. They have a plan. This plan is designed to make sure Workiva is competitive for the talent. The goal is also to align executives' interests with those of the stockholders, making sure their goals are the same. Now, after all this, how will you find the results of the annual meeting? We'll announce preliminary voting results at the annual meeting. We also will disclose voting results on a current report on Form 8K that we will file with the Securities and Exchange Commission. The annual compensation program includes elements like base salary, short-term incentives, and long-term incentives through the forms of equity. The committee reviews compensation and benefit programs to confirm this program. These are highlights about how they manage and pay people and what they don't do. I have anti-hedging, polging policy, clawback policy, recoupment, emphasize performance-based compensation, and have limited perquisites, what they don't do, guarantee bonuses, SARs, pension plans, tax gross-ups, and repricing stocks. Last year, 96% of votes were in favor of their executive compensation. That shows that WORKIVA's compensation practices are aligned with their investors. Okay, so the three main parts of pay are salary, short-term incentives, and long-term incentives. The base salary is mostly for the day-to-day things you need for experience and role, while short-term incentives rewards hitting key corporate financial goals, and long-term incentives use equity as a way to have managers act like the rest of owners of the company. iScale's base salary was at 61 and earned $412,000. The company has three metrics in the short-term plan, which are revenue growth, non-GAAP operating income, and operating cash flow. So what numbers did they hit? As for the numbers this year, there's over 6,300 customers. Their subscription revenue retention rate was 97%. That's actually very good for customer retention, and their revenue was almost $740 million, about a 17% increase from last year. The committee said the revenue growth was crucial. Non-GAAP operating profits were a key incentive. So they put heaviest weight on these metrics. So how were the payouts? Well, SCAL would be payable at 199% or more than $1 million. Dual count came out at $429,000. The base salaries for the team provided stable fixed compensation for day-to-day responsibilities to these executives. Equity also becomes a big player. With RSUs, employees are more aligned with stockholders, while PSUs can increase rewards. You can access more information about the company on the SEC website. You can defer settlement of restricted stock, but WORKIVA does not make any contributions to deferred compensation. WORKIVA also has anti-hedging and anti-pledging policies. So what does this mean? Pledging refers to using company stock as collateral for loans. Hedging limits downside risk. What are the potential payments if things go south? For example, Bridget Bonner has stock awards valued at over $200,000. And what about the CEO pay ratio? Well, the median employee makes about $145,600. The CEO compensation is at $13,500, $24,443. This makes for a pay ratio around 93:1. So for every dollar a median employee makes, the CEO makes 93. The measures of what they value for the top positions are revenue growth, non-GAAP, and operating cash flow. One of the things that is being voted on is to change the liability of directors to make it less for them. They can't just do anything though. They still need to have good intentions and can't take an improper personal benefit. To quickly recap everything, they want you to vote for the directors. Say you approve of the executive pay, decide how often to vote on it, approve that officer protection clause, and okay the accounting firm. Now for my take. WORKIVA seems to be on a reasonable track with good revenue growth and customer retention numbers. But there are some downsides to think about. The company isn't profitable yet, relying on non-GAAP measures, and that CEO pay ratio is definitely something to watch. And all things considered, WORKIVA looks like a company trying to balance expansion with sustainable practices. Whether or not this is the best play, that is for you to decide. Thanks for tuning in to this Corporate Decoder episode. If you found this breakdown helpful, please like, comment, and subscribe for more deep dives into the world of corporate filings.